morning, everybody. I'm Michael Episcope, co-CEO of Origin Investments, and I'm joined with David Scherer today, co-CEO of Origin as well. We're both excited to be here. David and we started Origin back in 2007 together and have been friends even longer, since about 2003. And this is our very first Ask Us Anything. It's sort of a take on Ask Me Anything, but there's co-CEOs here today, so we're going to steal that phrase, and it's Ask Us Anything. And just like it sounds, this is about asking us whatever is on your mind, really investment related. So, we'll keep it specific to that, but there's no specific agenda today. We're gonna, the agenda is created by you with your questions. Now, we already received a lot of questions, more than 60 in total. And I can tell you, I'm glad Dave is here today because there are some really great questions and I'm looking forward to hearing his perspective answered there. If you have more questions today, please enter them into the Q&A box and we will get to those. We're doing this because as we've grown, this is a scalable way for us to stay connected to you. We want to answer the questions that are on your mind. And one of the unique characteristics about Origin is that we pride ourselves on our accessibility, the accessibility to David, to me, the ability to call us, to email us. We've always loved that connection with our investors, and we truly enjoy that part of our day-to-day and welcoming new ones to Origin as well. There are three themes that sort of dominated the questions that were emailed in advance. They were interest rates, they were current state of the economy, they were fund-specific questions about income plus, multifamily credit fund, growth fund 4, QZ, everything. And then there were a lot of questions asking about guidance as well. And I will quote my favorite economist, Yogi Berra, when it comes to guidance. It's tough to make predictions, especially about the future, but we will do our best to let you know why we are well positioned for anything that lies ahead. And we know many of you are concerned about rising interest rates, the threat of a recession coming, and how that's going to impact real estate. And we will we'll cover that during this Ask Us Anything presentation. This will be no longer than an hour. It could be a little shorter than that, depending on how many questions we get during the Q&A. And right now, what we're going to do is start with 2 polling questions to the audience to break this up a tad and then learn more about you. So I'm going to hand this over to you, Dave, to get us started with the polling questions, and then you can hand that back to me, and I'll answer our very first question that was mailed in.
All right, thanks so much. I love that Yogi Berra quote. It's amazing. All right, so let's post the polling questions, please. We're going to ask 2 questions today of you. This is also an opportunity for us to get a better read on what you're thinking in aggregate. And so at each of these, I don't know what the cadence is going to be. It'll really be a function of demand and attendance, but let's say it's every other month, every quarter. It could be even more frequent than that. We will also be asking questions to learn more about you and your needs. So if you could please answer these, and what we'll do is we'll actually publish the results. I think there's roughly 400 attendees this morning of what you're thinking along these lines. And this is the first, and if you could please post the second when you're done. I believe we'll do this in about 45 minutes. We'll post the results. Do we have a second question as well? There it is.
All right, we'll give everybody a few minutes or a few seconds to answer that, and then we'll jump right in here.
All right, so while you're doing that, Michael, why don't you just get started? There's no presentation today. That's by design. We have roughly 6 questions that were sent in, and I already see a couple in the live Q&A. So we're gonna literally go question by question. If you use your name, we will use it. If you want to be anonymous, we will be anonymous.
First question, how will cap rates move as interest rates increase? And this question was asked in a lot of different ways, so I'm just going to tackle it here. And Dave, feel free to fill in any holes. What we've seen in the market as of today, because we've had one of the most, what I'll call, violent interest rate movements in the last 10 years, certainly maybe even the last 20 years, but we saw interest rates move from almost 1% up to 3% over a year from, pandemic sort of state of the economy till now when we were recovering, inflation came in. And we haven't seen nearly an equivalent in cap rate movement. And that's because growth is on the other side of that. And I'll get to that in a second. But we have seen some cap rates, I would say 25 basis points, 30 basis points in the market. Cap rates were extremely low right after the pandemic, especially in 2021. And they have increased something. But the other side of that, when you think about a cap rate or your total return is a function of a cap rate, which is your cash flow and also growth rates. So if you have perceived growth in the future, high perceived growth, your cap rates are going to be depressed as a result of that. So you'll have lower cap rates because you'll make that up in growth, because that's how you get your return is through those two mechanisms. Where cap rates will change is when growth slows down, and we haven't seen that. So growth is still incredibly robust, especially in the markets we're in. It's far above normal. There's a housing shortage out there even today, and we're looking at in our markets, even after some of these markets in Phoenix and Tampa and Austin have grown close to 20% or north of 20% in the last year. There's still high single digit, low double digit growth in these markets as it sort of finds equilibrium as these demographic changes take place. So cap rates haven't been affected by interest rates. They will be affected more by growth rate in the future. Now, it's also important to note that we're not in the market of buying existing properties, because it doesn't make sense to us to buy at a 3.5, a 3 3/4 cap rate and then borrow at 4%. That's a negative carry. And if you amortize any principal on that, you have incredible negative carry. And you don't buy cash flowing real estate so that you can pay the bank every month. So what we've been primarily engaged in is lending at rates 12% on average, 12.5, 13, depending on what date it is, as low as 11.5 when interest rates were really low. And building to a cap rate in the future that's anywhere between 5.25, 5.5 on underwritten. Some of those will achieve more than 6% in the future, but that's how you mitigate interest rate risk significantly, is by building to a cap rate in the future, adding value to your property in that case. And so we've been in this defensive posture for even pre-pandemic because of what we saw as a distortion in the market between replacement cost and the value of existing properties. And we're incredibly well positioned today to really whatever comes our way, we're well positioned. We'll get into this a little bit more into the individual funds themselves, but that's my answer to kind of interest rates and cap rates and how they're impacting us. So Dave, if you have anything to add there, feel free to.
Not at all. That was really well done. And we're going to have to pick up the cadence. We've got 60 more and we got to do this at 30-second clips. But that was
all right. Lightning rounds.
Couldn't agree more with what you said. Growth is much more important right now than any other variable. And rent growth has been incredibly strong. So my question, what impact will rising interest rates have on current and future Origin fund performance? So great question. A couple things. One, we hedge interest rates. So we do that in a combination of ways. But candidly, I'm not positive our competition does do that. It's something that you need to ask other managers. We use fixed debt when we can. And during construction, we use a combination of swaps and swaptions. We've been very successful even in the last 3 to 5 months in protecting a lot of our future cash flows and returns. We're very proud of what we've done in the last quarter in this area of interest rate hedging. If you have interest in greater detail, please go to our webinar on that topic. There was a whole hour-long segment on that. The other thing I'll tell you is in underwriting, we always price in we call it the SOFR curve now because LIBOR has changed to SOFR, but that reprices every day. And so on a weekly basis, we update that when we're doing all of our underwriting. So the short sort of conclusion of what I'm saying is all of our underwriting now prices in all of the Fed expected rate hikes for the rest of the year and the following year. So our base case is very, very different than maybe it was 2 years ago in interest rates. We're assuming 3-4% variable interest rates now in our models as you go through time. In general, we're very conservative, and I know you're smiling because I took more than a minute. All right, let's keep moving. Your
All
question.
right. Well, I'm going to jump ahead because we actually knocked out several questions there in a row. So I'm going to go to the last one in interest rates. And what is a strategy not to get hurt by rising rates? And we talked about this a little bit already. Is the way we underwrite by putting in higher interest rates, assuming higher cap rates in the future, using fixed rate debt, and also hedging interest rates. But the biggest thing is adding value and making sure, to us, this is why we're in ground up development, because the existing properties out there are more susceptible to rising interest rates than the ground up development. And we've said this on a lot of our webinars that it might be counterintuitive to think that ground up development is less risky. But if you have a core property that you've bought out there and cap rates go up and interest rates go up, you're not adding value in that state. And so you're very susceptible to any decline in the property and hurting your equity value considerably. Whereas when you're building ground up development, if your margins are 35%, 40% building, and the economy turns around and something happens and you're only making a 10% margin, you're just making less money. You're not losing money. So we're always thinking about this. They're great questions about interest rates, and certainly it's on everybody's mind right now, and it's on our mind as well. And we're doing a lot internally. This is our job. We're risk managers.
All right, let's move on to theme 2, which is concerns about the economy, inflation's guidance. So I'll take the first one. Do you agree? We've sort of covered the interest rate block. Okay, so do you think a correlated downturn is possible across publicly traded financial instruments and private real estate? And this is a really good question. And in some shape or form, we get this on every webinar. And we also have almost 3,000 active partners, clients right now. So I know, Michael, your teams and investor relations get lots of these types of questions. Look, the stock market and the bond market have had a terrible first 5 months. Stocks are down generally 15 to 20%. The bond market has been hit as well, rising interest rates. Maybe it's down 8 to 12%. The traditional portfolio hasn't worked. And so a lot of the questions we get are, okay, your funds are up anywhere from 3 to 6% in Q1. Everything else in the world is down. Well, first of all, I'm happy that I'm in your funds because that's worked and helped my portfolio. But secondly, when is it coming for you, right? Some iteration of that. And we don't know the future for sure. But I'd agree with one thing Michael said, which is we're incredibly defensively positioned, both by the 40% margin when we're building or by the margin and the capital structure protection when we're in preferred equity positions. And those are really the only 2 things we're doing here. So we're super proud of our returns in 2021 because we feel like, getting a 22% return in income plus, we kept up with all the risky strategies. But now this year, it might be more difficult to market. And I think you're going to see a huge dispersion between what we do as risk managers versus the competition. In terms of what will happen going forward, I do believe that you're going to see, if the economy slows, based on the Fed rate hikes, and they need to break inflation. And in order to break inflation, sometimes you do have to push the economy into a slower growth or even a recession. Real estate is not immune to that. But remember, the one thing that we have going for us that's truly unique, the biggest input into CPI, the Consumer Price Index, is the cost of housing. And the cost of housing is measured as rents. That's how they come up with it. So in other words, your CPI is going up because our rents are going up. And that's exactly what's happening here is our rents are going up very quickly. And Until that stops, we have incredibly sound fundamentals. And then the other thing I would add, the substitute good for renting is buying. And, you know, Michael, you pointed this out, so I'm stealing your thunder here, but you're completely right. When the price of housing for sale went up, and it went up significantly, and then the cost of borrowing went up from 3.5 to roughly 5, no one can afford to buy a house. And so that's exactly what we're seeing play out, is there's just a massive amount of renters now who wanted to buy but couldn't, and now they have to delay. And so our fundamentals keep getting stronger. And so we're in this interesting period where inflation is actually, you hear hard assets are good in inflation, and we're actually seeing this play out for the first time in 40 years. Is that's actually absolutely right. Hard assets are good in inflation. All right, next question. We should get through like 10 now, right?
All right. Yeah, exactly. Yeah, let me just add, and I'll tell the story, but real estate always belongs in your portfolio no matter what. And I had a great call that came in yesterday from an investor just out of the blue. And he said, hey, I just want to, thank, everybody at Origin, because I just had my portfolio review, and what David said is so true, that stocks and bonds are down. And the only thing that saved his portfolio was real estate during that time period. And real estate really buoyed his portfolio. He still lost a little bit of money, but that was sort of the bright shining star. So it's regardless of what your outlook is, asset allocation is important, and having real estate as a component is a huge part of making just better risk adjusted long-term returns and absolute returns. Okay, I'm going to jump in here. What is your perspective on rising labor costs, maintenance, CapEx, and the risk of rising property taxes impacting your returns? So this is really a question about inflation and what's happening. And yes, construction costs have gone up considerably over the last 2 years, on average around 40%. And we've sort of alluded this, but what's kept up pace even more is revenue. And revenue matters more than even construction costs, because we would all love to be building at prices 2 years ago. That $50 million building that you priced and built 2 years ago now costs $70 million, significantly. But keep in mind that rents in some of these markets are up $300, $400, $500 per month. So when you're talking about a 300 unit building, it's $20 million more to build, but the value on $400 more in rent is $30, $35 million. So the spreads have maintained themselves significantly. And we talk about, labor, everything's up, labor costs, the cost of lumber, the cost of steel, every input into this. And that's why we're having, this inflationary environment. But to me, like, if you want to beat inflation, you have to be in the assets that are creating the inflation, to David's point. So the margins are still there. And I think that every period in history, you always want to buy at last year's prices, rent at last year's prices. That's just not how it works. I can tell you that when we're sitting here in 5 years, today's prices will look cheap compared to where they are in 2 years and 5 years. And you've seen this over, decades, that replacement cost just continues to go up. It doesn't ever go down.
Thanks, Michael. So how are we confronting supply chain, labor shortage, material costs? What are we doing to mitigate that? So a couple things. One, when we model, we're putting in inflation factors that would have been perceived as quite high, 3, 4, or 5 years ago. So now we're putting in, like, for example, on operating costs, we are increasing operating costs, 4 to 6% a year. That used to be more like 2 to 3 in models. Operating costs are, a huge component of future NOI, operating income, in models. The other thing we're doing is, we're putting in much more contingency in our construction budgets. So whereas before it was 4 to 6% of total costs, now it's 4 to 6% plus an additional, 1.5% per month if we're 6, 12 months from getting a GMP, a guaranteed maximum price contract. So if you think about that, that's 4 to 6% plus, if you're a year out, another 12 to 15%. So these are unprecedented times, and we're building in that margin. And then on the ground, what we're doing is we're trying to figure out ways increasingly to get GMP faster, to lock prices, and then also to lock input prices of commodities. So like, for example, with lumber, we're trying to buy lumber even earlier than the GMP. And then you have to start dealing with, well, how do you store it? What are the extra labor costs with moving lumber twice? What's the warranty issue of holding lumber for months longer than you normally would? So you really get into the weeds quickly. But again, we are thinking about it and doing it. These are questions that you should ask other managers. I'm not positive they are. They might be, but the weeds matter. And if you're concerned about interest rates, you need to ask your managers not what they're thinking about, but what they did. And if you're concerned about input costs and supply chain, you need to ask them what they're actually doing. And so I can tell you, our team is doing a lot more than thinking about it. And here's the reason. It's very simple. We build to a huge margin. And so what we want to do is make sure that we can preserve the margin by controlling the uncontrollables, right? I can't control interest rates. Michael cannot control the cost of lumber in 4 months. To give you an example of how crazy this year's been, the Canadian truckers shut the border between Canada and the US to protest COVID mask mandates. That shut off the lumber supply. Lumber went up 50% in 6 weeks. There is no way that you can predict or hedge that unless you're in the market actively buying lumber, which we are.
Yeah. I have a friend who owns a lumber supply company. They used to leave quotes out for 3 months. Now they're 24 hours. That's how fast that market is moving. Next question. If inflation continues out of control, do you see the possibility, and what would be the effect on Origin Fund returns if the federal government reestablished rent control laws as in the 1970s? I will say I don't think there is any chance that they reestablish rent control laws. I think that was one of the worst policies, and I would hope that our legislators have learned from that. It ruined cities, it destroyed economic value. There are other ways to handle what we're seeing here, this inflation in rents, affordable housing, rent control, but giving economic incentive to developers in markets so that they can build more affordable housing. That's what we've gone to, that kind of model. So I don't see rent control as an issue. I know some politicians are pounding it. I think it's popular among some segments of the group, but I highly doubt that is going to happen. And I'll say that on record here today. I think this idea of inflation is circular. To Dave's point, rent is one of the reasons why inflation is happening out there. So it could be that if inflation continues out of control, rents are the ones rents are driving up that inflation, and we do incredibly well in this fund. I mean, I know that, going back as far as time and investment, you want to be in hard assets. And a piece of real estate is nothing but an amalgamation of hard assets. And if you're in the right locations, in the right cities, you're going to grow. There's also real estate that is declining in today's value. So that's not always the case. If you're in retail or if you're in office right now, those are losing value. But if you have demand and you're in a segmented demand and you're in a hard asset, you're going to do very well. So there's always possibilities. Yes, this is calculated risk that we're all taking in this. We feel good about the horizon, about the fundamentals of real estate, the markets we're in. We spend a lot of time on research, making sure that we are getting things right. And we do everything in a portfolio as well, and use moderate leverage and manage as much risk as we possibly can along the way so that we protect and grow wealth.
Yeah, and to be clear, when we say we like the fundamentals of real estate, we're saying we like the fundamentals of multifamily rental real estate. That's all Origin does. We wake up in the morning and 50 people think about it all day, every day, and then repeat. It's not by accident. We're in multifamily because it's been the highest returning, lowest standard deviation real estate asset class for 30 years. That's why we moved into it 12, 14 years ago. It's based on data. And it's proven in the last 12, 14 years when we've been in it to maintain that position. We also don't believe that multifamily is disruptable. Technology is disrupting everything. It won't replace your need for housing. You will need somewhere to live in 100 years, 50 years, but I'm not sure we'll work the same. I'm not sure we'll shop the same. I'm not sure we'll go out to entertainment the same. These are all things that are in flux. So that's why we do what we do, and we believe in the fundamentals there. Replacement cost, because Michael's mentioned it a lot, is really relevant if the asset in question or the asset class has demand. If you have demand, replacement cost is really important. If you don't, it can be a trap. I'm buying this office building for 50% replacement cost. So what? No one wants to rent it. There's no cash flow that'll ever come through it. Who cares, right? So you actually have to caveat that variable with the demand function. I'm going to move on to fund specific questions. I'll tackle the first one. I'll be very brief. Will Fund 4, and I'll expand it, QZ2, QZ1, will we consider single family rentals? That's essentially horizontal rental strategies. They're homes with common pools and common areas. The answer is absolutely yes. We're doing 4 of them right now for our various funds. This is an asset class that's in extraordinarily high demand, but you have to find large land sites at the right price that also have access to retail and the things that people want in their lives. So absolutely yes, we're doing it, but we're being very selective.
Next question. Do you see a time where depreciation will not offset distributions and start having tax ramifications for income plus? Yes, we do. And we started tilting the income plus fund almost a year and a half ago, 2 years ago, when we got into the pandemic. And the first iteration of income plus fund or the kind of base case was that we were going to be 70% common equity and 30% preferred equity. And those 2 scenarios allowed you to more than offset, actually have excess depreciation. But because that fund is defensively positioned, we're now 60% preferred equity and 30%, I would say 20% common equity, and then the other 20% ground up development in that fund. So there is a chance you'll still have a significant amount, 70, 80, maybe even 90%. I know this last year was really great. I think 95% of all the income was shielded through depreciation. But as some of those preferred equity deals roll off, there could be tax ramifications. And understand though, like as mindful as we are about taxes, our first duty is to protect and grow capital. So we don't want the tail wagging the dog in those situations and say, hey, we promised you tax-free distributions, and then get into risky assets that allow depreciation to do that. We believe that this is the best portfolio allocation today and gives us the most downside protection while still capturing upside.
Yeah, and an interesting thing, Michael, is we also have depreciation in our preferred equity investments. So, the only thing that doesn't produce depreciation is our cash position. Everything else is, and that's something we negotiate into our pref deals as well, because it's something you have to add to those investment structures. Okay, I'm going to answer 2 very briefly. The question is, how is the current economy affecting QOZ Fund 2? Have the fundamentals changed in terms of returns? And then the follow-up is, what cap rate are you building to in QOZ Fund 2 investments? So the short answer is no. QOZ Fund 2 is extraordinarily strong in its pipeline. We know 90% of what we're going to invest in, we're already working on all those deals and have been for the last year. Why that's important is many of those deals have been purchased at land prices that are deeply in the money now. So if we're working on a deal for the last year, perhaps it was put under contract in late 2020, early 2021. Land prices have gone up significantly. So these are things that we don't mark up any of these acquisition land prices. So the fund investors benefit from that lower basis. And then in other instances, we've entitled assets. Like, so for example, our large land site in Nashville, which will be 720 units, across 1 to 2 phases. when we bought that, we thought we could get 500 to 600 units on the site entitled. It wound up that we got 720. So that's a significant entitlement value that's been accreted over the last 8 to 10 months. Again, we don't mark that up. QZ Fund 2, I'm more confident in the returns than I was a year ago. In terms of the cap rate we're building to, we don't trend. So we don't trend rents during construction. So we'll call this an untrended cap rate. And basically what that means is for the first 2.5 to 3 years, we're holding rent growth at 0. And that cap rate is generally anywhere from a 5.1 to a 5.3. If you trended rents, of course, it would be significantly higher. But it's another way of stating that we're very conservative with how we underwrite. And that's why we like to surprise people with upside returns, rather than tell you what we're going to do. We would rather you be happy later. But that's a short answer. 5.1 to 5.3 untrended is what we generally look for. And that's another way of getting back to the margin Michael talked about. A 40% margin would take you about to a 4 cap. The market in Nashville right now is probably a 3.6 to 3.8 cap. So maybe the margin's just a touch higher than that.
Dave, I'm going to grab 2 questions in a row because they're just short answers, but you basically answered this. It's another question about QZ Fund 2 investments and what's the break-even cap rate. It's north of a 5% when you think about it net of fees. So cap rates could rise to 5% and that fund will still be fine. Your money will be safe. The next question is, in the Income Plus Fund for the common equity investments, does Origin manage the day-to-day operation of the assets? The answer is both yes and no. We do not have property management, but we have an asset management department that is as vertically integrated as you can possibly be. And we have technology here in Chicago where every single metric you can imagine at the property rolls up into our technology. And so our team here in Chicago actually gets to see what's going on with leasing traffic, latest leases, the rollover in the rent, any expiring leases. And we have actually, Dave oversees this team. And I would say something that is a huge advantage is that the investment management team has created a playbook. So when we go in and we hire a property manager, they are adhering to our playbook. This playbook is 40 pages. We teach them how to manage our property, what best practices are, and we're rolling this up together. And our managers, our property managers actually are very appreciative because it's value add to them as well. And as an asset manager, it's really, really important that you stay on top of the property manager. But from a business perspective, we don't want to be in the business of property management because of our strategy being nationwide and in different, just different, like we're in garden and we're in wrap and we're in urban and we're in suburban and all over the place. So we pick the best property management for the area and then we train them and then we keep an eye on them and hold them accountable.
Question about Income Plus versus multifamily credit fund. The question is, which fund is better? I can just tell you, I'm invested really heavily in both. So the multifamily credit fund is our lowest risk investment. It's the lowest risk because it's built cash flowing multifamily that's owned and operated by the largest, most sophisticated players with the biggest balance sheets in the world. I mean, that's your credit for that. And there's 30 years of history of owning this type of credit. There's never been losses. So really confident in its ability to protect and grow wealth. And you sit, 30 to 35% in a protected capital structure position, meaning if values of multifamily real estate went down 30%, you're still not losing money. So I'm heavily invested in that, but understand it's all a yield and it's a debt instrument. The return is somewhere between 8 to maybe 10, 11%. Most of it is current pay yield. Some of it is accrual. We target about a 6 to 7% current pay. I'm heavily invested in that because it fits my portfolio need. I have a lot of money in growth and I wanted more in very protected income yield. Income plus, if you were going to be in one fund at Origin, I would say Income Plus is the fund to be in, because you get some of everything. You get some protected investments, you get some core depreciable assets, and you get some development. And it is defensive in its structure, and it's tax efficient. So there you're talking about a little bit more total return, 9 to 11, but the difference is multifamily credit in an up market will get you 9 to 11. There is no upside tail, it's debt. Income plus will. Income plus did 22% last year, right? So in an up market, you have this upside equity tail. It is just a slight bit more risky, but in exchange for that, you get that upside tail. And then the last thing I would say is, if you have money that's in an IRA or a foundation or any sort of tax efficiency to the money, that's a great place to go into multifamily credit, because it's a debt instrument. And by definition, you don't get to depreciate. Income plus is actually very tax friendly and tax efficient. So you actually don't want to use an IRA or a 401k or a foundation to go into that fund, because the fund is actually really tax efficient itself. So these are all things to think about when you're investing. I don't think one's better or worse than the other. They're different. And for me personally, I'm in both.
I love your perspective, Dave. All right, so here's a question, and I actually put some math to this as well. This is income plus question: why base case return of 10%? And I'll take you through kind of the math really quickly. Our average debt right now is 12%. We've issued some at 11.5 and some as much as 13%. The market was coming down for a while, and that's going to make up 50%ish of the portfolio, maybe a little bit more, but we're going to use that. The equity component, the common equity, is about 30% of the portfolio, and the average return there, just base case, is around 10%. Development is 20% of the portfolio, and those properties over the next 3 years will generate, best target is on average around 18%. They're probably more than that. I think that's conservative. And so like when you add up all those together, you get to a gross return of about 12, almost 13%. Then you have to deduct fees. And in the Income Plus fund, we have an asset management fee of 1.25%. And then we get a performance fee as well, and there's fund expenses. So if you take the entire load, it's about 2.5%. You get to just north of that 10%. And that's what we believe that we can deliver on a regular basis through this portfolio strategy. So it was a great question. Again, I can share the math with you. It's pretty simple, but that's one thing to consider also, is that when you compound, when you put all your money in at one time and you earn 10%, and there is a drip program here as well that you can enter into. So if you don't need the yield right now in this fund, the distribution yield is about 5.7%. But 10% annualized, right, compounding year over year over year, creates a lot of wealth. And that was the reason why we created this fund in the way we did, is that we wanted to take all of your money and focus less on the IRR and more on the wealth building. And if you take 10% and multiply that over 10 years, 20 years, 30 years, that's a significant amount of wealth that you're building. If you go into a fund that's generating a 14, 15% IRR, but it's a called capital fund and they're sending back money at different periods and playing the IRR game, you can't measure the amount of wealth that is over time. Plus you have taxes and other drag and things like that. But this fund is incredibly efficient. And to David's point, if you're going to be in one fund in Origin, this is the fund, especially for the long term, to compound money.
All right, so marketing is telling us that we need to start addressing the dozen live questions. So we're going to take a couple more that emailed in, and then we're going to move to live. And then please don't submit your questions in the chat. I'm going to answer one because Nola, thanks for your question, but everyone else, please send them to the other one. She had a question. He or she, I apologize, I don't know, about Michael, when you're talking about returns, or I am, are we quoting net returns or gross? And net means after all fees. The answer is always net. We only talk about net returns. That's what's returnable to you. So if you give us $1 million and we give you back 2 million, then you made $1 million. Same with IRR. It's net of fees. It's what you get. And it's a great question because a lot of our competitors talk about gross, net. It's very hard to keep track. With us, it's always net of fees. It's what's deliverable to you. So thanks for the question. I'm going to move to questions about QOZ. And we're going to do this very quickly because I think we covered a little bit of it. The broad question is why QOZ? Like why Origin for QOZ? And the answer I'm going to make is very simple. Since 2015, we're a top 3% real estate manager in the US. And so, out of an opportunity set of over 300 companies, we're number 11. And that's not for QOZ alone. It's for 4 different funds. It's for Fund 3, Income Plus, QOZ. We have dozens and dozens of deals now that are realized and investors who enjoy these returns. And I also believe that our returns aren't just good in and of themselves. I think we're a good risk manager and we're defensively positioned. So you'll see even more outperformance. Look, there's going to be a difficult period at some point. We don't know when it is, but real estate goes up over time, but it doesn't go up in a linear way. And so if there were going to be a correction, it could happen next year, the next year, the next year. I don't know when. You will be very happy you're here. We will do better versus our competition in those periods than even other periods. So why QOZ at Origin? Because really, if you want to be in real estate and multifamily, Michael and I believe that that applies to all of our funds. QOZ is our capital gain fund. Michael, one more question on maybe Origin versus competitors. I see there's some questions about some of our competitors here as well.
Yeah, go ahead, Dave, grab it.
So there's a question here about, if I were trying to select a manager, what would I do? And they link to a couple of our competitors that do deal by deal. We have competitors that are deal by deal. We have competitors that are fund managers. And I would strongly suggest that anyone who wants to get into real estate, please get into the fund manager side and not the deal by deal side. And there's a lot of reasons for that. And we've written about it extensively. We don't have a lot of time right now, but please go to our education center. And, Michael and I have both written about the benefits of a fund. You get diversification, you get cross collateralization of equity, meaning we can't charge you incentive fees unless all of the deals are being successful, not one by one, which you'll wind up in the deal by deal model. However, when you make that decision, and hopefully you will, that you want to be in a fund that's managed, you then have to run a process of selecting the manager. And selecting the manager is another thing that we've written about extensively. In fact, I'll tell a story. It's quite funny. One of our investment advisory partners ran an unbelievable process on Origin before they selected us for Fund 3. And the last of 12 things they asked of us was, do you have team members who've left Origin? We want to interview them. And we actually had one, and we put them in touch and they talked. And after which Michael talked to the person who ran the process and said, that was an amazing process. How did you come up with it? And her answer was, that was easy. I went to your education site and I downloaded the article you wrote, and I went 1 through 12. And literally, Michael and I went to the education center, and Michael, you had written the article that she ran. So in other words, come to us as a resource, whether you select us or not. Use our education center. We can show you how to pick a manager, and then run the process. Everything is better when you run an organized process. And I think you'll be happier with the endpoint. Okay, so let's move to 1031s. Why don't you answer the question about 1031s in our funds? We get it a lot. Are they eligible for the funds? Why, et cetera?
Yeah, it's a quick answer, and then I'll move to the live. The answer is no, we don't accept 1031s into funds. We can't do that. I would say that the next best bet, if you can't find a replacement property, would be QOZ, that you can defer those gains And the advantage of QOZ over 1031 is that you don't have to invest the principal, just the gain. So you can actually invest a lot more than you can in a 1031 exchange. This question is from Scott. This is a part of the live Q&A. Scott, thank you for your question. Can you go deeper into why it's rational that the real estate market is pricing value add core plus at a higher or similar level as development? Seems like a used car being valued higher than a new car, which has happened recently too. Scott, I have actually used that very example about used cars. There are distortions in the market and it's not rational. And what we know about distortions and these events is that eventually they work themselves out. They normalize in the market. And again, this is why we are not doing value add. We are not doing core plus. We're not buying existing properties. We're building. And what Scott's referring to here is that you have properties that are 20 years old that are trading above replacement costs. You have newer properties that are 5 years old that are trading 20, 30, 40% above replacement costs. And I'll just say to everybody on this line, be careful if you're getting into value add funds today, because everything works on Excel until it doesn't. And this is what we believe. You have to fundamentally be adding value to the properties and really looking at that, because replacement cost is the ultimate governor. That it's like gravity. Everything relates to replacement cost in this market. And you don't want to be in a 20-year-old property at $300,000 a unit when you can build brand new for $280,000 a unit. It doesn't make sense. So thank you for a question. This is the essence of our whole strategy and why we've moved to pref and ground up development.
Here's a question about accessing risk in equity deals. How do we do it, right? And so first of all, if you want to look at a deal and be able to make a decision, a good educated decision, you're going to need a grounding. You're going to need to see the model, number one, the Excel model, and you're going to have a grounding in finance, but also a grounding in the idiosyncratic inputs, right? So like, what do you know about rent growth? Is that defensible? What do you know about competitive analysis in that space, in that market, in that submarket? What do you know about cap rates? Are they trending rents? Are they not? What's the ROE on and spend? What's the cap rate drift? What's their cost of debt? Is that achievable? What's the refi? There's all of these things. And what makes me nervous for investors is I don't know, unless you're an expert in the space, how you possibly could know that. And so I would advise, if you were wanting to do deal by deal, I would advise that you hire a consultant. And it would be a really good use of money. We don't do that here, but I would actually spend, if you're going to invest $1 million in a deal, spend $5,000 to have someone who does understand these things do that work. Because I really believe there's a familiarity with real estate where people consume it, you live in it, you entertain yourself in it, et cetera. So there's a familiarity that people think, well, I understand it, but you don't. And, I don't know how to fix a car. I don't know how to, if my son breaks his arm, I can't fix it. There's so many things I don't know how to do. I know how to do this because I specialize in this. And I would really recommend that you dive deep into hiring a consultant or hiring a manager that specializes here, because you won't be able to do it unless you do one of those two things or you're in the space. Okay, so Michael, we have time for two more and then we'll move to live.
Oh, I'm already on live, Dave. This question is from, yeah, go ahead. You can keep, we'll just trade off here. Okay. I know there were plenty more questions that were emailed in. This question is from Kai. I really like that I can invest in Origin directly versus go through broker dealer advisor. I'm interested to hear what led to that decision. Kai, that's a great question. And that really goes to the why of Origin, why David and I even started this company back in 2007. And if you go back, this is pre-Jobs Act. We were investing in real estate and just looked at the landscape, and the retail landscape, where high net worth investors could invest, was just dominated by what I would say below average real estate investment managers, or managers that were good, but they saw the retail investor as a way to get really, really wealthy. So you would have a great manager and a great deal, but then they would take 50, 60% of the upside, and there was no way to get ahead. And when we got into this, the simple fact was we were just trying to invest our money, grow our wealth, turn our assets into income. And we just said, I'll never forget, we're like, if this is the best the market has, we can do a better job. And that was sort of the beginning of Origin. But at the beginning, it was the two of us looking to invest our money in real estate. And then it morphed into friends and family. And then it was articulating the vision of transforming the way individuals invest in real estate by bringing a truly institutional platform to them. And I will tell you, the reason why others haven't done this, or at least, it hasn't been done as much, it takes a long time. You have to build a track record. You have to, gathering together thousands of investors to scale, to make it profitable. Most investment managers would rather go the institutional route. And that's what you find, is that there's adverse selection, is that the really good ones go and get $100, $200 million checks from pension funds. And so we've always been dedicated to the individual market because it's who we are. And we believe that this market was being underserved and that we can make a difference here. So thank you for your question.
All right, I'm going to answer three really fast. Okay, and then I'll be on the live. So follow up on how we use swaps and swaptions. An investor is wondering about what's the downside of using derivatives. In the case of swaps, there is no downside in the sense that we're fixing an interest rate that should be fixed, but it's during construction. So typically you have to borrow a variable. And it's binomial. It either goes up or down, but if we were to lose on the swap, we're winning on the borrowing cost. So that's not an issue. In the case of swaptions, that's an insurance policy or an option. So you are paying premium. So your downside there would be it expires worthless and you paid a premium for a hedge that didn't work. In the case of our swaptions, they did work. We made a lot of money on them, but the inverse is borrowing costs are higher. So you're losing on borrowing costs, you're winning on what you made on the swaption. Again, we did a whole show on that. And then I just want to jump all the way down to the last question emailed in, which was, how do you guarantee an ROI? And ROI is short for return on investment. The short answer is we don't. We don't guarantee any ROI. These are what we believe the range of returns will be for our funds. We've been very accurate over the last 12 to 14 years. Candidly, our funds have done better than what we've targeted each time. But there is no guarantee. Just as there's no guarantee in the stock market or the bond market. This is what we believe is attainable. And it's somewhat based on, a decade plus of historical return.
There's a question here from Scott. Scott asked about publicly traded multifamily REIT valuations and just making an observation. They have come down a lot. We follow them. We follow specifically MAA, CPT. Those are apartment REITs that are in our markets. And it's his question really is about comparing private multifamily valuations to public multifamily valuations. I got to put my glasses on here so I can read this soon. And is that important to Origin to monitor that delta? It's important for us to keep an eye on multifamily valuations in the public sector. They are a good proxy to sort of leading indicator, if you will. But I would caution you that the public REIT market is part of an index. And when the index goes down, invariably what will happen is that public REITs will follow. And a public REIT is not a piece of real estate. It's very different. It's an operating company. And we were doing this analysis recently, and the public REIT equivalent cap rate right now is about 4.8% where they're sitting right now. And that's not necessarily where cap rates are going to, because you have to understand that in a public REIT, you also have general and administrative expenses of tens of millions of dollars that a REIT has to amortize. So 4.8 can look like a 3% very, very quickly in those instances. But they are good leading indicators. It is something we watch, but you can't look at that and really understand what's happening in the private market. There's an enormous disconnect. And when we go back to even 2009, 10, 11, you had moments there where the private market never got above 6% and the public markets were trading at 20% cap rates. They were both dislocated, but the private markets never even got close to where the public markets are today. So there's a big delta. It could mean that the public markets are a great buy sitting where they are today.
And to be clear, the private markets are a little bit lower, not a lot, 2 to 4%, but they are lower than they were in December. I'm talking about multifamily real estate. So we know this because we are selling assets constantly for our legacy funds. Fund 3 is selling 3 assets right now. These are going to be enormous returns still, but those true outlier buys, the funny money, the crazy money, the sub 3-4 cap rate stuff, that's done. That repricing has already started. So to some extent, the public REITs are reflecting the private markets too. I'm going to answer 2 questions. One from George. He's asking about, would we invest in Louisiana and Missouri for QOZ? The answer is no, George. We focus in the cities we are. We have people who live there and have for a long time. We have relationships, we have competitive advantages, and we've also identified the cities we're in as high growth cities over long periods of time. We like the fundamentals, our machine learning, our AI is corroborating what we think. So no, we don't chase new markets like that, and we won't. What we will do is go deeper and deeper into the markets that we know very well. And there's plenty of deal flow to not only fuel those funds, but others right where we are. John Weaver, thank you for your question. It's a really good one about Income Plus. His question is really, it's more of a concern about the exposure to multifamily development, because we're getting exposure both through direct common equity, but also preferred equity. And, I would tell you, one, you're right. We're going to wind up with 60 to 80% of the fund in those assets, multifamily development, and that's by design. So Michael and I both want this concentration because of the margin. And I mentioned this before. In common equity, we're getting 35 to 40% margin. That's both upside and enormous downside protection. In other words, if you're building for $250,000 a unit, and you're selling for $350,000 to $370,000 a unit, if there's a correction, you're losing profit, not principal. And then in terms of preferred equity, you have the margin plus an additional 15 to 20% of capital structure protection. So I'm very confident in the construction, and that's a proactive decision that was made over 2 years ago. And we feel even strongly about it now. But I appreciate your question. And if you're not comfortable with that exposure, it's the wrong fund for you, because that's not something that we want to change at this point. I think we have the right strategy. Michael, that was my 2.
All right, I'm going to grab one that was emailed in earlier. How can investors get comfortable with Origin as a money manager? Is there independent third-party due diligence available? The answer to that is yes. If you are an RAA, we subscribe to FactRight. They've done due diligence on us. Dave already mentioned that on our website, you can go there and download, or you can actually search for manager due diligence. We've written about this, whether you're doing due diligence on us or somebody else, to get comfortable as well. And we can also give you references that if you're interested in investing here, talking to an investor, like yourself, or if you're an RAA, we can connect you with other RAAs who have experience investing with us. So we're happy to help you. Like, one of the things we want to make sure everybody is comfortable and that there's an understanding, setting expectations before you invest, because to us, that's a good partnership. And a way to start a partnership is that you feel really comfortable about your investment and that you've asked the right questions along the way. And that's why we write about this stuff and provide all this educational content. So thank you for the question.
Last question. This is more your wheelhouse, Michael. David asked a question about if he were to pass away, do his beneficiaries of his estate get the step-up basis in the same way you would a stock if he's in QOZ or Growth Fund 4? Or
Yeah, I'm not, I'll tell you right now, please email me, michael@origininvestments.com. I'll get you the answer here. I'm fairly certain that it's treated the same way because I believe there is a step up in basis, but I'm neither a tax expert nor an estate planning expert, but we have in-house counsel that can get you the answer there. So we're happy to do that for you, but email me when you get a chance, please.
Yeah, I'm glad you said that. That's not what we do. Please email us. Our general counsel and accounting teams will respond. I think the answer is yes, but I'm reticent to say yes and then be partially right. Okay, so we're going to publish those survey results if we can right now. We're exactly at an hour, so feel good about what's happening. So ask Origin, what percentage of your overall investment portfolio do you plan to allocate to private real estate? So it looks like 41% said more than 20%, 31% said 10 to 20%, 28% 1 to 10%. So, you know, that's really interesting. With 41% more than 20%, this is obviously an audience that wants to diversify and wants to have more of their portfolio in hard assets. Are you surprised by that, Michael?
I'm not surprised in many ways. I think you and I understand the benefits of being in real estate. I think there's more wealth that has been built investing in real estate than any other asset class out there. You know, operating companies aside, maybe people owning their own companies, but I think from an investment standpoint, we know that real estate has outperformed stocks over the last 5, 10, 20, 30 years. And interestingly enough, David and I commissioned a study going back about 4 years ago from 2 PhDs in real estate to kind of look at the allocation or the right allocation of real estate in a portfolio. And it was interesting because what they came back with was that the more you allocated to real estate in your portfolio, the better it did on both a risk-adjusted basis, lower volatility, and higher returns on an absolute basis as well. You won on both sides. And they had to actually tweak the model because they did the more they added, the better the portfolio got. So when you looked at it, you're like, well, you shouldn't even be in stocks and bonds because real estate, you know, has all the returns with lower volatility when you do the traditional 60-40 portfolio. So I think people inherently understand that. And I think David and I did, but it was really interesting to see the data come to life. And I'll tell you one of the reasons why I believe that is true and holds true is because we think about real estate as just buildings, right? And space and occupying. But real estate has a huge definition, especially in the public REIT market. You can gain exposure to sectors with hard assets. You can gain exposure to technology through real estate by being in things like cell towers, in data centers. You can, you know, e-commerce is a play on industrial right now and what's going on there. What's happening in the residential, the demographics, the millennial demographic, the baby boom demographic, what's happening with senior living facilities, things like that. And so real estate is incredibly dynamic, and playing these sectors through hard assets has been a great way to reduce risk and generate higher returns and more yield in your portfolio. So I guess, you know, the one I'm surprised that a lot of people, want to allocate more than 40%, but I'm not going to, play advisor here. I think that everybody has to make that own decision, but I wanted to share that the information does support that.
Yeah, it's funny. I remember when we got the paper, it was a 20-page paper back. And essentially the conclusion was be 100% in real estate. And Michael and I both looked at each other and were like, we're not publishing this. That's not something we're sharing. It's self-serving. And candidly, that's not responsible. I mean, you need to have a diversified portfolio. Real estate should be part of it. But yeah, that was the general answer, is more is better. So the second question, ask Origin, how do you select a fund manager? And this was actually one that I thought of because I always think about this. How do you, if you want to invest in real estate, how are you figuring out what manager to invest in? So 24% of you said referral, 74% personal research. Wow. And then only 2% advisor. So I would tell you, Michael, and I'd love to hear your thoughts, but I'm shocked by this. I would think that the advisor would have a much larger role than 2%. What do you think?
I share your opinion here. Yeah, that's very interesting. Yeah, 74%. I think it's also a function of our base here, people, and we have a lot of individuals who are do-it-yourselfers. And I know that we did a poll many years ago, and I want to say that less than 50% of our investors actually had a wealth manager, but 2% seems really low on the advisor side. So it is interesting to see as well. So thank you to everybody who answered that poll.
Yeah, and since 74% are doing their own research, please use our education sector segment, and Michael's written great articles on manager selection. Use it as a compass. It'll be very beneficial for you. Thank you for your time. I hope this is our first maiden voyage on Q&A. We did a decent job of answering all the questions. Candidly, we didn't answer all of them, probably 60%. So if we didn't answer your question, please email it in again and give us feedback. Let us know if you found value in this. Let us know if you'd like to see it on a monthly cadence, quarterly cadence. We want to be accessible. We also want to make sure that we're valuing your time and vice versa. So David at Origin Investments and Michael at Origin Investments, very, very easy. Shoot us a note. Thanks for your time. Michael, you want to kick us off?
Yeah, thank you, everybody. Really appreciate your time today.
All right. Bye-bye, everyone.